Rich Dad, Poor Dads, Robert Kiyosaki, Grant Cardone, Simon Zucchi, Rob Moore, Samuel Leeds, even President Donald Trump understand that using equity in their properties to buy more investment properties is the foundation to them compounding wealth. The crazy thing is, this is not complicated knowledge. You can do what they do, what I do. So before you click off this video and think, bullshit, let me explain. Equity is the difference between what your property is worth today minus your mortgage. And in this video, I'm going to explain to you, yes, you at home, how you can use your equity, the equity in your home or within your property investments to buy more property investments. If you don't know me, I'm William Gale, the founder of British Home Buyers, one of the UK's largest home buying and property sourcing companies. And I've also been building my own personal property portfolio over the years. So not only does that give me insider knowledge you can benefit from, but quite literally making sure I get this right is critical to mine and my clients' financial success. So make sure to like and subscribe because it helps me out. And let's start from the beginning. Let's say you bought a property 5 years ago, and at the time it was worth £200,000, and that's what you paid. You would have put down a deposit. Let's imagine that was 20%. So in this case, £40,000. You would have paid the remaining 80%, the remaining £160,000 using a mortgage. Now, of course, the numbers for you personally might be a bit different. You might have bought a property for a higher or lower price. You might have had smaller or bigger deposits. I also appreciate you might have got an interest-only mortgage or a repayment mortgage. But for the purpose of just keeping this simple, keeping this example simple, let's imagine you took out an interest-only mortgage, and let's imagine 5 years later, so today, the property you bought 5 years earlier has gone up in value 25%, which is in fact exactly the amount house prices have increased over the last 5 years. So I'm not making this up. Your property would now be worth £250,000. Now, your initial deposit is still the £40,000 you put in 5 years ago. And because the mortgage was interest only, the mortgage is still £160,000, as all you paid for over the last 5 years is the interest on the money you borrowed. You've not repaid any of that initial £160,000 of debt. However, as the property has gone up in value 25%, which is the average over the last 5 years, it's now worth £250,000. You have now created an additional £50,000 of value or equity that is being created for nothing, all because prices have gone up. So you have today's property value of £250,000, you deduct the existing mortgage of £160,000, and that will then leave the total equity you have locked in your property totaling an incredible £90,000, over double the deposit of £40,000 you put in at day one. Is it starting to click for you now as to why investors love property? So at this stage, you have two choices. You can decide to leave things as they are, keep that additional £50,000 of equity locked into your property along with your initial £40,000 you put in. And there is nothing wrong with you doing that. There is a psychological comfort to having more value locked in your home. You may want to focus on paying down the mortgage over the remaining years and be left with a house bought and paid for instead. Or you could decide, wait a minute, some of this extra £50,000 sat there doing nothing could be working harder for me. You could use that extra equity to buy a property investment to help you make even more money. Now, if you think that's a good idea, this is how it would work out. And at this stage, you'd have three choices around how you could release that equity as cash to invest. One, you could speak to your existing lender about borrowing more money. Two, you could take out a second mortgage with a new lender, which is especially worth doing if you can get a better interest rate with another lender. Or three, if your mortgage product is expiring, you could refinance the entire property with a new lender at a more competitive interest rate. So if this is something you want to do, I would highly recommend, irrespective of which of those three routes you take, that rather than just go to your high street bank blindly, that you speak to an independent mortgage broker. The reason that is so important for you is because a high street bank will only offer you the mortgage products they offer, whereas a mortgage broker has access to the entire market and will recommend the best and cheapest product from all of those choices. Using a mortgage broker is you shopping around for the best deal possible. Using a high street bank isn't. And I find high street banks are almost always more expensive than what a broker can get me. If you're not sure which mortgage broker to use, look at the description below and I've left a link to mine for you to use. If you're not sure if you have equity in your home, look at it this way. Over the last 5 years, house prices have increased 25% on average. However, over the last 10 years, if you bought 10 years ago, they've increased 59% on average. Over the last 15 years, they've increased 81% on average. So think back to when you bought your property, and that should give you a rough estimate as to how much value it has increased by. You might be pleasantly surprised how much equity, how much value you have trapped in your property right now, and you didn't even realize it. So let's say you decide to refinance your property to get as much equity out as possible to reinvest in another property investment. Well, how would that work? Now you're starting with a property not worth the original 200,000, but now 250,000 5 years later. You currently have that deposit of £40,000 you put in at the start, and you still have that £160,000 of debt you took out 5 years earlier. You now have this extra £50,000 of equity. With your mortgage broker's help, you would refinance the entire £250,000 property on another 80% mortgage, which would release £200,000 of debt. You'd use that to pay the £160,000 from that £200,000, but you would still be left with the remaining £40,000 as cash you can then invest. The best part is because the £40,000 is debt, you would pay no tax on that money, so you could literally go straight ahead and invest that money. You would still be left with £50,000 of equity in your property as your 20% deposit, which, if you remember, is still higher than the original £40,000 you put in to begin with. If that all makes sense, excellent, like and subscribe. If not, there's no harm going back over it and making sure that all those numbers make sense to you. Now, at this stage, you're probably thinking, great, Will, I've got an extra £40,000 in my bank, but I've also got £40,000 more debt against my property that I didn't have before, and now I've got to pay for it. And you're right. The trick at this stage is to make sure you can make more off that £40,000 than it is costing you. So the simplistic way to think about this is if that £40,000 is costing you 5% interest a year, so £2,000 a year, £167 a month, but you're able to make 10% a year, that debt is making you twice as much as it's costing you. So yes, it's costing you £2,000 a year, but it's making you £4,000 a year. So remove the £2,000 cost, and that's leaving you with £2,000 profit, all from equity that would have ordinarily been trapped in your property. The goal is to make sure your debt is costing you as little as possible and that you're making as much money from it as possible. And the difference is then the profit. And so a good way for you to do that is to buy an investment property. In my view, there is a difference between buying a home and buying an investment property. When you bought your home, you're not thinking about what it's going to rent for. Whereas when you buy an investment property, that is the most important thing to think about. Not every property is going to be a good property investment. And if you're not sure how to select an investment property, check out my other videos. I've got it all there for free. But the simple rule I follow is my 8% rule. Any property investment I buy must rent for at least 8% of its value. And my property portfolio rents it between 8% to as high as 18% on some of my holiday lets. So let's use your newly discovered £40,000 through a simple example. To keep it simple, I'm going to assume all debt is at 5% interest. In reality, you're probably going to be able to get less than that. But let's be realistic. You now have £40,000 as cash from refinancing your other property, and it's costing you 5% a year, so £2,000 a year. You can't use that entire £40,000 as a deposit. Why, you wonder? Because you need to keep some money aside to pay for your fees, legal fees, stamp duty, contingencies when buying a property. So you have £30,000 to use, keeping aside 10 grand for stamp duties, fees and contingency fees for unexpected costs. You find a property worth £150,000, you pay £30,000 as a deposit, you get an 80% mortgage to pay for the remaining £140,000. So that's £140,000 of debt, and that's cost you another 5%. So £7,000 on top of the £2,000 for your initial £40,000 you released from your other property. So a total cost of £9,000 a year, £750 per month of debt costs. You are now the proud owner of a £150,000 property investment. Amazing, congratulations. But it is costing you £750 a month. How annoying. But is it? Remember, I mentioned the 8% rule to you earlier. Well, this is how it applies. As you now own a property worth £150,000, you can rent. If you rent it at 8%, that totals £12,000 a year, £1,000 a month, £250 of profit. But if you're able to find 10% yielding properties or get creative with HMOs or holiday lets and secure higher yields, these are the sort of figures you'd be looking at. 10% would be £15,000 a year, £1,250 a month, £500 profit a month. 12% total would be £18,000, £15,000 a month, £750 profit a month. Let that sink in for a moment. That equity trapped in your home or in other investment property could be working harder for you. And it is this cycle that all property investors, even the well-known ones like Robert Kiyosaki and Grant Cardone, Simon Zutshi, Rob Moore and Samuel Leeds, even President Donald Trump, all use to continue building and compounding their wealth. In conclusion, I have admittedly kept this example simple to make a point, but I've tried to be realistic using high interest rates, making sure you have plenty of contingency money left aside. But you can see the key to making these numbers work really well is buying the right high yielding property investments and staying patient. Before you go, YouTube seems to think you'll like this video up here, but before you click it, please make sure to like and subscribe to see more of me. See you up here.